Let's talk about one more thing. Then we'll have a quick blaze through JD Wetherspoon because we've got about 20 seconds before we reach our hour mark. They released their full year results last week, and that's why my portfolio hasn't done better. Revenue was 2.1 billion, which was up 4.5%. Like for like sales growth, a number that we have focused on with so many companies this year. So it's not just looking at this one. It was up 5.1%. That's not. I mean, we've heard lower numbers recently. It's fair to say across the sort of FTSE 250 and elsewhere in UK high street retail, but that number is down from 7.6%. I mean, their Q4 like-for-like sales growth, by the way, which is the kind of bit that's new in the full year report, and always worth keeping in mind how much you were already supposed to know because they've reported it for earlier in the year. The Q4 bit is basically in line. It's 5.1, and the whole year is 5.1. So steady in that regard, and steady in upwards. Underlying EPS was 48.9p, which was up 5.3%. Operating margin, which is a thing that people have really been focused on with the likes of JD Wetherspoon and hospitality and so on recently, with the increases in employers' national insurance contribution and national living wage rises since April. That came in for the year at 6.9%, which is not bad, I think, especially when you consider that the previous year was a 6.9%, which means so far, in any event, they've done a decent job of offsetting margin pressure. Why and how? And can they repeat it? And do they need to repeat it? I guess is the big question. There are a few reasons. One is higher volume. Well, that helps when you're a company like Wetherspoon. Generally speaking, these kind of EDLP, everyday low price, bargain, low consumer value companies rely on scale, at least in some capacity. They rely on being able to push stuff through in greater volume and generate more revenue on the same cost base. And 5.1% like-for-like sales growth has helped with that. But that's not the only reason. In fact, it's probably not even the biggest reason. They have managed to hang on to their some of the other bits of their margins pretty well. They've managed to refinance quite a bit of their debt, which has brought down their interest expense really quite significantly. So they're now down to about 6.5% in terms of a cost of debt, rather than 7%. And when you consider a company like JD Wetherspoon, which is fairly debt heavy for its size, chipping off half a percentage point here in the context of 7 of them, so taking off a 14th of it, just under 10% or so of your stuff, that can make quite the difference to the amount of income the amount of interest, you're paying. Net debt did go higher as a result, and that kind of raises a question of risk if interest rates stay higher or even go higher, with inflation pushing them in that direction. Worth paying attention, I guess, to the thought that they are mindful of this risk. We've historically seen it in the time that we've been covering them on this show. They hedge their debt using swaps, basically. And what that means is that in 2023, when we saw interest rates going higher, as a reminder, free cash flow pretty much quadrupled because they sold all their swaps, and it did what it was meant to do, which is generate cash to offset the extra interest that they were paying. So hedging is not free. Hedging is a cost, but they have done a decent job in terms of bringing down their interest costs. They've reshuffled their menu, done all kinds of things to hold prices where they are, and generally speaking, kept them the same. The dividend goes nowhere because it never goes anywhere, or at least it never used to go anywhere. It looks like it's been cut down to 8p from 12p or something, but it hasn't. They've gone back to paying it in 2 lots of a year of a 4p and an 8p, whereas last year they only made one payment at the end of the year, and that was a 12p. So it's staying at 12p a year, and it stayed at 12p a year when they were paying one pretty steadily and pretty much without changing. What is worth noting, though, is they spent about 19 million on their dividend, and they also spent 67 million on share buybacks in 2025 fiscal year, as they call it. It's not quite over yet, but they're slightly ahead on this, and that means that you get kind of 2.6% dividend yield and 9.37% share buybacks. Cut that in half for enterprise value for the moment because we've just taken our net debt higher, but you still get to around a 6% or so return, which is not terrible in a year that was supposed to be a real struggle. We will see what happens in the next one, I guess. They continue to do stuff like consolidating down pubs, which reduces costs. They continue to do stuff like buying freeholds, which reduces lease liabilities. All of this works towards holding down prices, and it feels to me like a bit of a we talk about Wise as a company that has deliberately held down its take rate, or indeed lowered its take rate in some cases, at the very least avoided taking where it could on its take rate. And we've said, well, this is a deliberate decision. This is not the market incorrect, as the market seems to incorrectly believe that Wise can't increase prices. Maybe they can. Who knows? This is Wise deliberately opening the gap between them and their nearest competitors on prices. I think something similar is true with Wetherspoons. They are, to an extent, beholden to the fact that they don't want to scare their customers off because they are relying on volume. But every time they manage to profitably hold prices where they are while everyone else pushes theirs higher, they raise the gap slightly. And that gives them scope in future to move higher if they need to. If they were, last I looked, they were about 30% cheaper than their nearest competitors. If they were 15% cheaper, their profits would probably double. Will they do that? Don't know. Not yet, anyway. So Tim Martin flagged inflation in the report, and he pointed out, he raised it as a political issue, and it's well known the UK already has relatively high energy bills compared to the rest of Europe. Make of that politics what you will. I think it's kind of a little bit petty, that one. What I am a bit more concerned about, though, is the upcoming budget. And I had heard it flagged that Keir Starmer had said he wasn't really going to go after businesses again. But as far as I can see, the Institute for Public Policy Research are blaming the UK's productivity crisis on drinking culture, and therefore encouraging the Chancellor to increase tax on alcohol. A few thoughts about that. One is that I think alcohol taxes, or certainly draft taxes, were held flat or indeed lowered perhaps at the last budget, because you saw it in the JD Wetherspoon share price. It jumped a little bit before sinking quite sharply as the sort of scope of higher NI and stuff began to kick in. I sort of wonder a little bit here, and I feel quite petty in saying this, but I think if you're busy writing things for the Institute of Public Policy Research and trying to bother the government with that, you shouldn't really have a say in what the UK productivity issues are. You should probably go and do something slightly more productive. To be honest, I feel like there are certain things you can do where you don't get to make pronouncements about why the UK is unproductive and propose solutions. This being one of those things. That's slightly mean of me. In fact, it's not. It's really mean of me. But it is basically the way I feel about that thought. Steve, what did you think of any of this stuff? Oh yeah, fruit machine sales are growing at a rapid rate as well, so leading recession indicator.
That's probably why his energy bills have gone up by like 7 million quid or whatever it was. So he's put more fruit machines in. I remember the penny off a pint in the last budget, Steve, because I remember them cheering wildly like they used to under the Brown and Blair days. And the reason that I thought that was kind of, well, pretty horrible, really, when you consider what the rest of the taxes that came with it, but was when Brown and Blair were in, it was about £2 a pint. So taking a penny off it was a fairly significant reduction. But when a pint's £7 and you take a penny off, nobody gives a shit. So that was kind of shows you about how sort of out of touch the politicians are with general folk. But yeah, my problem with this report is there's a lot of problems in this report, and he highlights a lot of things that have gone up for him. So he's saying, increase in national insurance, increase in labour rates, 60 million quid's worth of costs, non-commodity energy costs adding 7 million, extended producer responsibility tax, which is a levy on packaging, is costing him 2.4 million in the current year. And he's complaining about all these things, but one of the things he doesn't mention is that despite being a very shrewd operator with very cheap prices, he could do a better job of his balance sheet. He could smarten that balance sheet up. He could get rid of large portions of that debt rather than paying a dividend. He could have done that over the last 10 years. He could have prepared this business better for these things, and he hasn't. And that's kind of the Tim Martin problem, is that he's really good at highlighting problems with the world, but the ones that he's caused himself, he doesn't point at. And And that's a little bit of where Wetherspoons are at the moment. In this consolidation, this buyback period, would they have had a better return on that investment if they would have paid chunks of the debt off, Steve, rather than paid a dividend rather than buy back shares? I would say maybe. Would they have set themselves up to be able to offer cheaper prices for longer and make more profit by doing that? I would say almost definitely. So I think this is the wrong approach for Wetherspoons. I think the market thinks this is the wrong approach as well, but I think the market also thinks that he's likely to get another kicking at the budget next month. So it's a wait and see moment for me, Steve. I think that that's pretty much where I fall with Wetherspoons in that, you know, they've done a lot of finger pointing, but if you held up a mirror, he'd be like, oh, actually, maybe you're right there. I guess the other thing that's probably worth pointing out is that industry like-for-like sales are very poor at 0.5. Wetherspoons like-for-like sales were at 3.7, but I think they said their cost growth was 4.5, so that's their personal rate of inflation. So they've fallen behind on that regard. So look, it's all interesting stuff. I don't think this is a crisis in any way, shape, or form here for Wetherspoons, but probably not performing as well as you expected. Steve, what's your opinion on this one moving forward? Is it on the chopping block, or do you think there's more to come?
No, I'm minded to hang in there for the time being. The capital allocation point is an interesting one to me, though. Tim Martin's a pretty outspoken guy, as you well know, and he talks his own book in terms of agitating for change that will help his business, rightly or wrongly, and I mean that very genuinely. You can make whatever case you like, I don't really care. He's definitely talking about it. And in that sense, he's a little bit of an Elon Muskist. But I mean, unlike Elon Musk, I don't think he's genuinely just trying to bull his own share price higher, the way Musk is with Tesla. He doesn't do random stuff like splitting the stock or so on, where he just thinks it will make the share price go up and there's no particular reason for doing so. In the case of the dividend, I was surprised when it came back last year. I thought it was going to be hard to take it away, basically, unless you get into an emergency, you have no choice. It historically doesn't grow from Wetherspoons insofar as they are in growth mode. They do it by chopping down. If they want to pay out less in dividends, they chop off the buyback effectively. But I also thought that I'm not sure they really needed to get back onto that. The market didn't massively react to the return of the dividend either. I didn't particularly expect them to. That's the kind of thing where I might sort of start wondering whether they were going to looking to do this to try and drive the stock higher or something like that. Didn't really work, and I didn't really see it as that kind of move either. It just struck me as slightly confusing. I thought Rolls-Royce were a touch earlier than they would be, and the market did go for their dividend return as a strong sign for the business. It wasn't really the case with Wetherspoons. Could probably still live without it. I thought they could. I'd ideally like to have seen them do it some other way of pulling out costs, maybe paying down debt, maybe continuing to stick money into freeholds and reinvest in pubs and that kind of thing, where they are still doing it, but a bit more cash for that would have been my preference from the company at the time. But I don't have a clearer sense of what their opportunity set available is here. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.